Yes, I lost some credit and it hurt my heart. See, sometimes credit can feel like a lose-lose situation. See, let me explain. It's like when you fresh out of college and you go to a job interview and they tell you, hey, you need experience, but you can't get experience unless they hire you. It's a lose-lose situation. See, and that's a catch-22, right? Because sometimes credit can feel like that. So, for example, my situation, I wasn't using this particular credit card. And if you don't use it, if you don't know by now, you can lose it. But on the other hand, if you use too much of it, you can also lose it. So what do? How do you strategically use your credit cards so they won't take it away from you? Now, this is really important, especially if you're trying to grow and scale your business. You can use unsecured business credit cards to do that with 0% interest for a limited time. That's the power of stated income business credit cards. So how did this happen to me and how can you avoid the mistake that I made? So that's what we're going to talk about today. But before we dive into that, we have to understand the credit game. See, I always talk about business funding and business credit, two different concepts, because the particular card that I'm talking about right now today is based off business credit. All right, so business credit is when you leverage your brand new business or your established business and you go to other companies, you open up lines of credit with those companies using your business by yourself, EIN only. So this means you properly structure your business, you build a strong foundation, and you went to other companies, you open up lines of credit with those companies. So the company that I'm referring to today is Sam's Club. Sam Club is backed by Synchrony Bank. So I leverage my business by building up my business credit profile, adding some business trade lines on my business credit profile that report to the business credit bureaus. And I went to Sam Club and I was approved for a $16,000 unsecured business credit card, EIN only. Yes, it is possible for you to get an unsecured business credit card, EIN only. However, this particular credit card do not come with 0% interest. Why? Because it's too much of a risk for these financial institutions to take. Why would they give you a 0% interest credit card without any collateral, without any leverage? AKA without you leveraging your personal credit profile, the business owner credit, AKA your personal credit. So that's why this particular card have a really high interest rate. So now with my situation, $16,000, I don't particularly use this credit card. Why? Because it have a high interest rate. So I use it here and there. I haven't used it in a long time, to be honest. So what happened? It, like I stated before, if you don't use it, you can lose it. So if I wasn't using it, they cut my credit limit significantly. They cut it to $2,000. Now imagine if this was a consumer credit card, this was a personal credit card, I would be in really big trouble. Why? Because cutting my limit that much can really hurt my credit utilization, aka debt to credit ratio, which makes up 30% of your credit profile. It's the second biggest key component that makes up your credit profile. It's right behind your payment history. So between your payment history is 35%, your credit utilization is 30%. That's 65% right there. That's more than half that makes up your credit score. So I say that to say this. You have to use your credit card strategically. This means you have to understand how credit cards works. If you understand how credit cards works, you can easily manipulate them. Now, I was fortunate enough that particular credit card, the Sam Club card, does not report on my personal credit. It only reports on my business credit profile. That's the power of leveraging business credit. That's the power of keeping your personal and your business separate. Credit utilization, yes, it's a factor on the business side, but not like it's a factor on the personal side. It doesn't hold that much weight. It's a key component, but not the biggest key component, or even the second biggest key component. So we have to be mindful of that. So here's the thing when it comes to personal credit cards or consumer credit cards. Most of you right now, or you believe that if I don't use my credit cards, that's showing the lenders that I am very responsible. Well, it's doing the opposite of that. It's showing lenders that you don't need their product. It's showing lenders that you don't need that line of credit for whatever you're trying to accomplish. Because when they give you that line of credit, they expect that you need it and that you're going to use it. So if you're not using it, what happens? You're not building that relationship with them. You're not building that rapport with them. You're not building that trust with them that you can manage debt. That's why credit cards is way more important than installment credit. So there's two different types of credit on your credit profile. When you're looking at your credit report, you have installment credit and you have revolving. Installment is anything with a fixed interest and a fixed principal rate. Are you tracking? So let me give you an example. Student loan, car loan, personal loan, mortgage loan. These are all examples of installment credit. By the end of the month, you know you're going to pay $500 no matter what. It's not going up and down. The interest rate is not going up and down. Revolving credit is a different beast. It does not have a fixed interest or a fixed principal rate. The balance can go up and down. That's why it's more important when lenders look at your revolving credit card, they want to see, can you manage debt? And that's going to determine your risk factor. So if you have a credit card, now there's different types of revolving credit. You have, if you say credit cards, it's different types of credit cards: department store credit cards, medical credit cards, charge credit cards, personal credit cards, business credit cards, right? There's different types of credit card. Then you have lines of credit. Then you have business lines of credit. Then you have home equity lines of credit. So those are all examples of revolving credit. Anything that does not have a fixed interest or a fixed principal rate. So lenders want you to have a mixture of both. But revolving credit really tells these lenders, these financial institutions, that you can handle debt. So they put more stake into revolving credit. So that's part of mastering your credit cards, that understand that you need revolving credit in order to grow your personal credit profile if you want to get unsecured business credit cards with 0% interest by using stated income and projecting your income. That's the power of that, right? Business funding. So going back to, they cut my limit. They cut my limit because I wasn't using it. Now, obviously, I understand how credit card works. I master my credit cards, but that interest rate is too high for me to constantly use. And I have other 0% interest credit cards that I use. Now, how do you avoid this? Well, you have to stay consistent. And that was the thing that I didn't do when it comes to that credit card. I didn't stay consistent. I stopped using it completely. So they cut my limit. They're either going to cut your limit or they're going to deactivate the card because you're not using the card. So they cut my limit, and Synchrony Bank is notorious from doing this. That's what you have to also understand. Capital One is up there too, but Synchrony Bank will cut your limit or will just close your card. And credit cards can do this at any time. So don't think I'm not using my credit cards, you're building a relationship with them. No, use it, but do it consistently. So what do I mean by that? Let's break that down. So if I'm only using a particular credit card to pay my Netflix, to pay my gas, to pay, put fuel in my car, to buy groceries, I want to use that particular credit card all the time for that. Now, if I'm using this credit card to pay other expenses, like maybe in my business, maybe for marketing, maybe for staff, so I can use that particular credit card. But then I use my other credit card for equipment, for supplies. So I'm constantly using credit cards, but I'm being consistent on how I use it. Why is consistency the key? Because here's the thing. If you use a credit card, let's say for smaller bills, $15 a month, $20 a month, you constantly use that credit card. Then you decide, hey, let me use this credit card for a bigger purchase. So if you have a $5,000 limit, and you only be using $50 or $100 per month, and all of a sudden you make a $3,000 purchase, that's a red flag. That's inconsistent with your spending habits. So now you might be financially in trouble because you have to make a big purchase. So what they're going to do is close your account. They can. I'm not saying they're going to do all the time, but they can close your account or they can cut your limit. And right after you pay it off, they notorious from doing these lenders. Soon as you pay down that balance, slice, they cut your limit. That wasn't in my case. The limit was always where it was. I just got an alert and looked up, and my limit was cut down all the way to $2,000. Why? Because I wasn't actively using that card. So the moral of the story is you need to use your credit cards, but don't do it frivolously. Again, do it in a strategic way. If you're going to pay your bills with it, pay your bills with this credit card. I don't know, go shopping with this credit card, put fuel in your car with this credit card. So you want to be strategic about it. Now, if you want to close your credit cards, you have to be mindful of what's going to happen. A few things can happen. Number one, if you close your credit card, you're going to affect two things. Your credit utilization, which is huge. It's the second biggest component, as I stated before, that makes up your credit profile. So you can increase your credit utilization, which is going to lower your credit score. And also, you're going to mess up your payment history, or I would say your credit history. Because if you have that credit card for a long period of time, and based off your credit profile, that was one of your oldest accounts, it's going to hurt your credit history. So be mindful when you close accounts, particularly credit cards. Are you tracking me? So look out for the next video. You may want to watch this video in order to master your credit card. See you on the next one.